Hello, everyone. My name is Rachel Peabody, and I'm the Communications Manager for the Illinois Soybean Association, and we thank you for joining this webinar today. So we have presenters from Brock Associates, and they've been working with the Illinois Soybean Association to support improvements in farmer profitability, particularly through a better understanding of merchandising. The explanations in the conversation today are provided as indicators and interpretations. Buyers and sellers are always reminded to consult their own experts and make their marketing decisions considering their own physical, financial, and commercial circumstances. Our conversation today is being recorded to serve as a resource for others who may be interested and for you to listen to in the coming days and weeks. Now, a year ago, ISA conducted research to better understand the decision-making process of soy farmers' marketing and merchandising as it relates to their grain and oilseed production. After reviewing those results, it was recognized that most producers generally market to a very small set of buyers, particularly less than 3 or 4. It was also noted that farmers tend to deliver to an equally finite number of destinations. Creating alternative strategies for broader marketing and merchandising of corn and soy especially can be accomplished with a better understanding of all the different options that you have available. Careful consideration of the cost of maintaining inventory, logistics evaluations, including the cost of storage, calculating costs associated with transport, the time involved, and other factors can translate to improved profitability. Now today, our discussion will be led by Tim Brusnahan and Jason Moss with Brock Associates. They provide commodity price forecasting, research analysis, hedging and marketing strategies for crop producers, as well as dairy and livestock producers. Tim also has extensive consulting experience on the procurement and risk management side of the business for feed manufacturers, corn processors, and other end users. This should be an interesting perspective, and we're excited to have them with us today for this webinar. So without further delay, I'll go ahead and turn it over to the Brock Associates team. Thank you.
Thank you, Rachel, and appreciate your time. This is our first event with Illinois Soybean Association, and we look forward to others in the future. We'd very much like this relationship to be a good one for all members of the Illinois Soybean Association. It's always a good opportunity to do a meeting like this on a day where soybeans are up at least 10 or 12 cents, or at least they were a few minutes ago when the last time I checked. So just like Rachel's disclaimer, we too have a disclaimer that this is today's presentation is not a solicitation to buy or sell futures. Our relationship with Illinois Soybean Association doesn't allow that. Anytime any member would like to specifically discuss something that Jason or I say, we're more than welcome a phone call, and certainly our contact information is at the end of this presentation. We're going to talk about the Illinois market. It's been quite a year. We're going to talk about outlook, some other states across the country, some trade farm bill update discussion, some further outlook, and some strategies. And then we'll have some time for some questions at the end. To start out with, our role for the Illinois Soybean Association is to provide a global market outlook for members to utilize our content for their best interest, explain over time, certainly not in today's program, but explain all the tools available to some may be more known than others, provide some directions for best practices and some market education and some more efficient delivery that's further down the road. Certainly market highlights of this past year, we've had a phenomenal crop. The harvest didn't go quite as well as planting, but certainly for rolling the clock back to last May, Illinois and Iowa started out extremely well, very similar to 2004, when most of the crop was planted by the 10th of May. That resulted in well above trendline yields. That was basically the case this year. For soybeans, This year is a record crop. It's the largest crop in history. Several states had record yields for corn, second largest crop. We had a little bit more acres in another year. Yields were very good. The Iowa crop lost a little bit of field loss due to late harvest. Even at the end of November, we still had a lot of crops still in the field. Illinois was about done, but other states still had quite a bit to go. And right now, there's not a favored commodity that we see pulling acres away from the traditional rotation, but certainly the Dakotas indicate that they're going to plant less soybeans just because the soybean basis there is so wide. Other market highlights, so much has happened in the ag economy since the start of the marketing year, which the marketing year for corn and soybeans is September 1. Interest rates have moved. The general economy didn't finish so well with the equity market slide towards the end of the year. Current market conditions, to summarize, are just very different for mid-January than we've seen in other years. The trade negotiations, depending on which last breaking news headline you see, some of them have said good things, some of them said not so good things. It's just our opinion that until we see something done in the space of cybersecurity and technology, we're a little hesitant to know what a good timetable is for trade resolution. It can be overwhelming. It's certainly overwhelming for some of my agribusiness customers to have to stay in sync with all the trade news or lack of news at times. And for the most part, we really don't have a clue when this is all going to come to an end. We do know that farmers have a new farm bill, and it's one that did get passed, and they'll have to sign up similar to the previous one back in 2014. There does appear to be another round of consolidation in the farm community. Farms are getting bigger. There's certainly some stress. We've seen that Farm Credit made some comments to the news media about needing USDA to get back in business and get some things processed. We also saw co-op mergers, not so much in Illinois, but certainly in other states. And it certainly appears from our perspective, we're going to see a little bit more of that. As far as marketing is concerned, Jason and I have been down this path for a number of years now. Every year is a little bit different. Marketing is not an easy job. We're asked all the time, why is marketing such a challenge? And part of it was that back in the bull market years from 08 to maybe 2013, it changed a lot of market farmers' thinkings. Certainly, those years may have interfered with marketing decisions today. Greed may be another one. Market expectations, market understanding. Market doesn't give you a lot of time to think about making good sales, so when the price is there, you got to take it. Marketing, kind of the old adage of having to clean hog pens back in freezing temperatures back in the old days. Marketing's kind of like that today. It's not easy work. It's hard work, and but everybody's got to do it. At some point, someone has to decide when to sell, when to buy, and that's what Jason and I do to try and provide producer and our customers the information they need to make that decision. We talk about having a target of when to sell, make a next sale. Everyone needs a target, whether it's in the crop in the bin or the next crop you're planting. Having a target is not necessarily having a plan, but not having a target is the same as no plan. Successful marketing is a learning process. You have to stay with it every day. Markets are open just about every day of the year. Marketing does seem to be set for somewhat of a change. We're seeing more of these web-based buy-sell marketing platforms starting to become available. There's 3 that we are watching. They've been around for a while, but they haven't really been able to get support from the major grain companies but now we're starting to see that. But nevertheless, all farms are different. The balance sheets are different. Financial statements are different. Where your farm might be, the weather's different. All these things have to be considered. USDA most likely is going to delay their ag census data. This is from some of the material that they gather from their what they call their America's Diverse Family Farm. That large scale farming is very large in certain areas of agriculture. If you look in the middle there, basically says mid-size and large scale family farms still account for a third of total cash grain for a combined total of 72%. That's where our primary farm customer business is in the mid-size family farm. So we watch that data pretty close, but we also see that some farms just aren't going to make it work after several years of these lower prices. Jason and I have studied a survey that came from Farm Credit several years ago. This is from their report, so Jason and I did not rank these in any way, shape, or form. But what it says is that seasonal marketing and storage strategies, 42% of the survey respondents said they're satisfied, but about half are dissatisfied. That kind of tells us that there's a place for market education. Some areas of the country, there may be stronger seasonal patterns than others. Certainly the Dakota farmers are discouraged for having a poor soybean basis year after year after year and having to hang on to soybeans and wait for some kind of basis improvement. Although the second item listed here says that there's an interest in basic futures and options understanding, and that just less than half are mostly dissatisfied. But on the next slide, you'll see that their interest in pursuing that isn't exactly that strong. As far as grain merchandising, as you can see, 36% say they are satisfied, 47% say they are not. Maybe we'll see some improvement when we see some of these buy-sell platform web-based programs come out. It's hard to say, but it certainly seems like there's an interest, or they wouldn't be doing it. On the next slide, and this kind of goes with what I said earlier, advance your futures and options marketing basics, projecting costs, all of the things that we talk about all the time with our clients that they need to know. Couple of these things are things that we would put at the top. So I guess from our perspective, from Jason and I's perspective, and based on the Farm Credit Survey respondents, you know, we address these things in our business and our clients almost every day. But nevertheless, I thought I'd share this. I know Illinois Soybean Association does surveys of their own. This is one from kind of a different angle. Something I use extensively to see where the different users of futures and options are. So if you've never seen this type of chart before, everything above zero across the top part of the chart or graph represents long futures, means they bought it. Everything below zero means short futures, or means that they've sold it. So basically what this is the most transparent way we know to determine whether the commercial trader, which is typically the grain elevators or end users, or in fact ethanol plants, are either long or short futures. My next slide says the same thing relative to speculators. So the blue line is soybeans, the red line is corn. So as you can see, this is dated as of December 18th, which is the last reporting date we were able to receive from USDA or from Commodity Futures Trading Commission that tabulates this. And as you can see there in the far right, at the very top, the soybean position was a small short. So what that tells us is that a lot of soybeans are still held by farmers, because typically if there was any commercial hedging of soybeans bought from farmers, there would be some short futures. But since we raised such a large crop, the fact that the commercial was slightly long in early December to just slightly short tells us that there's still a lot of soybeans that are unsold in either in commercial or farm space. At the same time, we can see that on the speculative side, on my next slide, if I can get to it, there we go. The last time we were able to get the data, the large speculator was actually slightly long corn, but more importantly, the large speculator was still short soybeans. So if everybody remembers, there was a meeting in Argentina by the Chinese and US leadership on trade. But for some odd reason, the large speculator chose not to bet long and stayed short. So since we don't have this data up to date, we're not sure exactly where the large speculator is. We tend to think they're still short, but not necessarily long. If anybody has any questions on that, we can pick that up towards the end of today's session. So now turning to some of the fundamental parts of our presentation, we always start out with a balance sheet, how much we grow, how much we use, and what we have left over. This is all pretty much taught in basic economics classes at all the land-grant universities. The data on the left is 3 columns is USDA's data. We project our own estimates on the far right. Presently, we're looking at about 961 million bushel soybean carryover based on a 52.1 yield. For 2019, next year, we're looking at a reduction in planted acres. We're fairly certain the Dakota states will reduce soybean acres. The other states all depend on weather, maybe some other localized conditions that are mostly unpredictable until we get into February and March to see what kind of weather those states have. But this is our balance sheet and basically the core of our decision making of when to make sales for producers. So I'm going to turn this over to Jason now and let him walk us through the balance of these slides.
Yep, thanks, Tim. I'm going to go and be the one to talk a little bit about market outlook now. And just to throw out a caveat, it's kind of insane and very high risk for someone to do a market outlook right now in the middle of not having the report, the January report, the biggest report day of the year. And it's important for 3 reasons. One, there are the 3 big pieces we get out of that are the final 2018 crop size, the winter wheat seedings report, and knowing what the winter wheat acres are is kind of important to begin to talk about where the rest of the acres can slot, but also the December 1 quarterly stocks report. And those quarterly stocks reports are benchmarks for making sure we're on track with demand. So this is, we do this outlook with a lot of caveats, and we'll note the places where we can't necessarily verify. But like Tim said, 3 years of USDA supply and demand here, and we've got our balance sheets. But you take our 1920 balance sheet on the far right, that's kind of on hold. We should probably not have even had it there, because we really rely on, you got to know the final size of the 18 crop, and where your winter wheat acres are before you can begin talking about 19. But nonetheless, looking at the balance sheet, we know if you look at exports, back in the chronology of what happened with China, when the tariffs went into effect, and there were stages of it in July and August and September, and the month that USDA first ramped up the ending stocks on account of a lack of Chinese import demand, it increased the carry out to the tune of a little over 200 million bushels, and which the stocks to use ratio down in the bottom here, was 7.2%, 10%, jumping all the way to 23. Just massive amount of stocks on hand. Just to kind of characterize what is influencing the soy market right now, the positive or negative cues, whether they're real or perceived, just to quickly summarize. We do think if we are able to get the final January report, that the yields are coming down. The estimates are all over, but harvest weather ended up kind of on the crappy side, particularly in the northern part of the Corn Belt. Crush margins crush demand is up despite there being lower margins. Crush is about 35 million bushels ahead of last year, despite the difference in crush margins over the last year, dropping from about $1.20 a bushel down to that 25 to 40 cents a bushel. But crush is hanging in there. It's a South American weather market. We know that, or if you haven't heard, there's dryness in Brazil. There's too much water in Argentina. But those forecasts have moderated a little bit. Where it's driest in Brazil, they've got a rain coming this weekend. Where it's wettest in Argentina, there is going to be a little bit of a easing of that rain forecast. But we're coming to where we're coming out of the importance of weather, but it's still a critical time there for those. But those would be one to keep eyes on. Short-term positive cue is also China's commitment recently, there in the early January, to buy 5 million metric tons. We thought that it might lead to more, or there was rumor of it. 5 million metric tons is all they committed to. Helped spark the market a little bit. When there wasn't some more follow-through purchases, it actually started tumbling back over the last week. But in the negative column, we know that the trade policy with China is kind of dominating everything. And, if you go back to the middle of last year, when that first took off in May, we were right in the middle of a growing season where, weather market, growing season weather is a difficult enough variable as it is. And when trade policy with China was thrown in, there's nobody that quite knew how to handle it. The biggest regrets, the biggest success stories in marketing in beans were mostly a matter of luck. Not many in our industry, not many farmers, nobody, correctly assessed and marketed around ahead of and through what that trade policy did without a little bit of luck, and came down to how many bushels did you possibly get sold in the tens before it collapsed, and how many bushels did you not have to sell in the eights because you were backed into a corner of having to sell at a certain time. But that's still negative Q. And the government shutdown, none of us realized just how reliant we are on USDA data until they shut down for just long enough that got a lot of statistics that we need, particularly that January report. Been much better if they decided to shut down in March or September, some less influencing reporting. And it's not just that major monthly report in January. It's the weekly export information reports. So take a day like today. We have evidence that we can tell when export business happens, but we're not quantifying it and making it transparent to every player in the market in a way that makes it usable, discounted information to all. massive stocks amount. I say the 5th consecutive record crop. Should have 6th there, except we don't have a January report for me to actually confirm that. But massive stocks. I mean, we going from years of 1, 2s, 3s, 100 million bushels to last year when, on the tail end of Chinese tariffs, ended last year in the 400s and now 900. Just we haven't seen those kind of percent ending stocks since the early 2000 types. Negative Q that's on the horizon is the extra competition we're going to have from South America. Rough estimate, they're going to have about 20 million metric tons more soybeans around, which will be in direct competition with our massive pile of beans this year versus last year. And then more recently, this African swine fever deal in China is picking up some hype. And Reuters story yesterday, the latest was 900,000 hogs had been culled because of the disease, or died and they kicked them outside. But I've heard numbers all over the board. Nobody really knows. We know that if Chinese government says 900,000 have died, the number could be much higher than that. I've heard other estimates of up to 50 million of their 700, 500 million herd potentially dying by the end of the year. That's a huge variable, but that is eroding the demand for beans in a way that, so when it comes down to it, and you look at these factors that will influence the market one way or the other, that trade policy with China is the difference between our current carryout of 955 million, potentially dropping down to 800 initially, and maybe work itself down into the 700s, or staying at 950 or climbing even more. And that's before any South American size of that crop's factored in. Where the final size of the U.S. yield comes in, the South American 19 weather, I said, and then where planted acreage is going to fall. So one of the items in the January report that they were going to talk about, which I think most farmers were interested in hearing the most, is where the yields, where the rankings come out amongst the big states. So where USDA last left us with yield estimates, which was in the November report, since USDA doesn't touch yields for corn and beans in December, you look at your top 5 states, your 3 I states, Minnesota, Nebraska, and huge jumps. It was a relatively good bean year, and as I'll explain in a second, I think what that means for expected acreage changes in 2019 actually have a bit to do with how bean yields came out last year. So you look at Illinois, 6 bushels above last year's yield, massive. Indiana, 6 above last year. Minnesota, 2.5. But take Illinois, 6 above last year, but 5 above the record. And to get 5 above the state record yield as it is, those yields are going to play into that coming year's acreage decision. And frankly, ideas of how much acreage we're going to plant has just moderated, kind of gone down right in the gut of harvest when the basis was the worst and soybeans were the prices were the ugliest, and it looked like there was no hope in sight with China. At that point was probably the height of everyone talking about this massive shift of bean acres to corn that was going to happen the coming year. But the truth is, the reason nobody in our industry can accurately forecast the coming year's acreage that early in the season is because the markets change, and you need that January report to get a benchmark on how many bushels you're dealing with to know what you need to produce the coming year. But this is a summary of planted acres going back to 2010, really just to look for trends. And your major acreage changes are trading in your top 4, corn, wheat, beans, and cotton. The rest stay fairly constant. There was a time 5 years ago when grain sorghum picked up some acres. There was a little fluctuation there. that was largely with China had an import policy where they were buying sorghum to get around an import tariff of their own that they had, and we ended up planting a lot more to service that specific market. But corn and beans trade the most, and last year, 2018, corn and bean acres were the same, around 89 million. And this estimate I've got in the 2019 column is an old one, admittedly. I wanted to show how thoughts have changed on what acreage could do. So take this as probably October, November type of estimate, where corn was looking at potentially rising, 3.5 million, and wheat up 1.5, beans dropping 5, and cotton staying fairly flat. But for two reasons, we think this is kind of moderated. First, with the wheat, the planting weather to get wheat in ended up being pretty wet. Harvest was a little late, so wheat acres are probably going to be a little closer to up 1 million or flat to 1 million. And the cotton economics have changed dramatically in that the price has fallen out of bed. And at current prices, it would be very plausible for cotton to lose 1 million. So wheat gains 1, cotton loses 1, and frankly, corn and beans, at our latest guess, would probably be for corn to increase a couple and beans to decrease a couple, 2 to 3. And when it comes down to where the total acres fall at the bottom, there's nothing that we could factor in now that would lead us to believe that we should have more or less total acres than last year, which is why we pencil it out to roughly being the same and trading amongst each other in those top 4 crops. This is an interesting chart that looks at potential average farm prices for a given planted acres, which are those lines, and a national yield. Now these lines are 89, which is what we planted last year. So the red line is no change in acres from 2018. The gray line is losing 2 million. The blue line is losing 4 million acres. And this is an extremely difficult chart to build, believe it or not. Each of those points on those lines is a different supply and demand balance sheet you need to manifest, from trying to project the price elasticity of beans at different amounts of supply. So it's a heck of a lot harder than you might think. So in reality, you get down to those lower yields in the low 40s. Those prices on the y-axis are probably fanning more vertically, and they won't stay parallel from a yield of 58 down to 42. But the big takeaway from this is where yields have been the last few years in that 49 to 52, between 49 and 52 bushels an acre. We lose 4 million acres of beans, or take the gray and the blue line, or somewhere in between. And unfortunately, it just means that we have not seen the last of the 8s. And that's before factoring in how South America is coming along. And if they turn out to their crop to stay in decent shape, it's just not a whole lot of grounded supply and demand reasons to be that optimistic on bean price. If we kiss and make up with China, you almost, at this point, South America would have to fall apart for us to likely have a meaningful run into the 10s. Q1 exports, as I said before, we know we're down. We know that China not buying them is the #1 reason. Just a few quick charts here. Soybean disappearance and December 1 stocks. The DC1 stocks is the report we did not get on January 11th. So really a little bit flying blind on whether those are accurate or not, but building significantly. December 1 stocks in Illinois, not just rising across the country, but because of our river market and the way we can move them, I don't think we're building as burdensome of a quick rate in Illinois as some of these other states. And good evidence of that is that the basis was not as ugly in Illinois as some of the western and northwestern states in the Midwest. Tim, comment?
Yeah, my only comment here for everyone, just Jason and I had a little disagreement on this chart, so we chose not to put a 2018 Illinois stock estimate. With Illinois having over a 600 million bushel soybean crop, I mean, it's hopeful, and I hate to use that word, hopeful, that some soybeans have left the state of Illinois to either be processed in the southern crush markets. But, you know, we just couldn't agree to even disagree. That's why USDA does these surveys, and that's why they are important. They have the best tools and the resources to do that. But it may be possible that the Illinois soybean stock as of December 1 is in that 600 million bushel range, give or take 10 up or 10 down.
So here's a look at what Soybean Basis has done, looking at it in central Illinois and looking at it at the Gulf. And the gut of where it was the worst by far, it was right in that harvest time frame. As I kind of said before, for the beginning of the marketing year in September through the first 3 months of the marketing year, or 2 months really, was wide. At that point, the disparity between the price of beans at the Gulf and the price of beans at Brazilian port, that spread was $2 to $2.25, extremely wide. And then when our own basis bottomed, we started coming a lot closer to last year. And for the month of November and the month of December, it tracked in the same pattern and wasn't but about 10 to 20 cents off of last year during the same time. Now we get to later in December and into January, more crop starts moving. It's starting to widen out again. But really at this point, and just looked at some updated numbers, this competition coming from South America because their crop is coming on with no really significant threats. Right now, we're back to our price isn't competitive with South America anywhere in that March to August timeframe, because that spread between Brazilian price of beans and the U.S. price of beans at each of our ports has closed dramatically and is continuing to shrink, and mostly so to what the Brazilian crop is looking like, and less to do with any expectation on how much we might get a deal done with China. If there's one thing we've learned in the last 8 months, it's that nobody has an inside track on how close we are or how far away we are on getting a deal done with China. Not the closest experts to the ground that are dealing with it, the Cargills, ADMs, Bungys, Dreyfuses of the world, your big ones trading internationally, to the biggest hedge fund type of money in New York. Nobody's got an inside track on how close we are or not to getting that done, unfortunately. So price of Illinois cash beans in central Illinois have been trending, in pretty wide swath of 50, 60 cents wide, but we keep making higher highs and higher lows. This last big run up in late November, early December was, if you remember, shortly after Thanksgiving, after a long time without any talk of China. Even Trump tweeted, "Hey, we're going to start talking again," and it kind of had it take off. This is a seasonality chart going back to 1970, so almost just a couple years shy of 50 years of history of what month of the marketing year soybeans make their cash price high, and it's by year, and the years are listed there. And first shows over that much time that the highs have between September or May, June, July, August is where most of the highs typically come. And I put this chart up to really throw out a caveat. First, look at the last 2 years. So we're still in the 18-19 crop. We don't know that yet. But the last 2 years, in 16-17 made the high in January, and 17-18 made the high in March. Both very counter-seasonal to the long run, right? And because of the lack of Chinese buying of our beans, exporting less to them is really changing the seasonality of U.S. exports overall enough that it's changed the carry, the economics of storing beans, and it's changed the overall seasonality to where without a resolution with China, we could probably expect more counter-seasonal type of price moves. But the way I like to look at this chart is in cumulative percent. So if right now we're in January, we have roughly 33% of these historical years of making a high behind us. So the long run odds would say there's still 70% chance that the high could be in front of us. I say that with the caveat of in looking, we've also made the high early two of the last 2 years because we're in the third. So to not necessarily, without a firm resolution with China, and certainly why we have massive stocks, to not necessarily count on typical year in, year out seasonality of higher prices in June and July as before. You look at seasonally where beans have made their cash price low over that same 48 years, and it's either in the marketing year coming early or coming late. September is currently where the low was made. So if now we're in the month of January, there's roughly 60% of all those years behind us at this point where the current low is, and 40% ahead of us. So more sticking to seasonality in the lows than the highs, but just a good reminder to where it typically happens. And frankly, going back to last year, when the market they first set some tariffs in, and the market started to collapse in late May, and in late May last year, the high was in March, and to have sold very much of those beans before that point in time would have been ignoring a lot of seasonality. It would have been playing the short side of the odds. And frankly, bean farmers stay in business in the long run by playing the long side of the odds. So this chart is, I think, good consolation of why I don't think people can beat themselves up too much for not having sold enough beans early before the tariff and the collapse happened. Even though we're talking to Illinois soybean, can't do market outlook without mentioning a few items about corn. This is our corn balance sheet. Similar to beans, I don't know that our 19-20 balance sheet of supply and demand means much, because everyone else and us, you kind of rely on USDA's final 18 numbers to plug in to have a credible 19 projection. But if you look down to where ending stocks are, we built higher and higher stocks for a few years, but starting to step down from 16 to 17 to 18, dropping ending stocks from almost 16, 14 and a half, 11.8%. And for reasons we'll discuss, a little more room for being a little more optimistic than beans, or a lot more reason. But to characterize some of those same summaries in corn, we think the corn yield is likely coming down a little bit as well. I've heard ideas for anywhere from a half a bushel to 2.5 bushels, which would be a little bit positive. But looking on the other side, there's some demand categories that are likely going to get walked back lower. And to what extent the lower yields are offset by some lower demand. Like I said, we need that damn January report. but even if it lower yields, let's say a bushel and a half, that is roughly 120 some million bushels. If you look back at ending stocks, we drop supply down 120 million bushels for ethanol. Margins have really gone to crap with the collapse in the energies. Exports, we think, are still fairly decent, but we don't have any confirmation from USDA. Feed and residual could be worked down a little. To have an offset of 120 million in demand, if the yield were dropped a bushel and a half, it's possible. So lower 18 yields, if you were waiting for that to be the bullish catalyst for you to finally start selling more 18 corn, corn is still taking more orders from soybeans and what goes on with China than its own yield or some of its own fundamentals for the time being. Big macro trend of declining world stocks still that keeps working down. And the nice thing about corn, why there's reason to be, I would say in corn, patiently optimistic, is that we increase the corn acres and we get the same type of yield we've had the last few years, and that just holds ending stocks kind of constant, and would still suggest we plant more acres, we get a decent yield like we've had the last few years, and fundamentally it still means corn should spend more time in the 4s than the 3s on a futures side of things. But to rely on that would take getting China out of the way to trust those older fundamental statistics anyway. On the negative side, China's affecting it. We know the government shutdowns causing greater volatility. There is a lot of farmer selling that's just parked on the sideline, starting to get to the time of needing some cash flow. And on any rallies, there's a lot of farmer selling that is waiting to take place, which will work to cap it from going very far. And like I said, ethanol margins really went pretty bad with the collapse in the energy markets. And the same to be determined, the trade policy, if it's going to keep China on the negative side of things, or when our delegation went to China to talk to them last week, or the first week in January, and they had some positive headlines out of it. China was all set to make some goodwill purchases, sometime here in early January, and we haven't had an announcement of them yet. But getting things worked out with China is a difference of that carry out, staying where it's at in the mid 17s or even working higher versus possibly working down in the 1600s, depending on how that would go with China's buying, because they were talking about their goodwill purchases were pretty significant, actually. Corn yields, where they were, as USDA left us last in November, your top 5, I'll throw South Dakota in to include your top 6 states, and Illinois 9 above last year, which was also 9 bushels above its record. Nebraska up 14 from last year. Indiana up 14 from last year, and Minnesota and Iowa were the ones that were down. South Dakota, where harvest wrapped up in not too good a shape, is probably an area the yield's gonna come down. But coming back to why, and we think the ideas of the massive shift of acres from beans to corn has kind of mellowed out, is twofold. One, because the bean yields, if Illinois was 6 bushels above its record, 5 bushels above its record bean yield, and 9 bushels above its record corn yield, relatively speaking, was it a better bean year or corn year? Well, they're both good at the state level, but relatively speaking, that's a lot better bean year. So I think if farmers can pencil just a little bit more of a higher yield into break even on beans than they could even 1 or 2 years ago, and the price difference between corn and beans isn't quite as far over in corn favoring territory than beans as it once was, that's why we don't necessarily think it's going to be a 3 to 4 million acre, 3 to 5 million acre shift from beans to corn, but probably more in the around a couple million. Same look at price implications for the acres we might plant and where corn yield could be. Also a difficult chart to make, but where corn yields have been the last 3 years have been in that 175 to 180. So if you look at the yields from 175 to 180, and this red line is 89. So red line is the same acres as last year, and then picking up 2 million acres, and then picking up 4 million acres, which is why this is the reason we can be a little patiently optimistic on corn. Maybe is that we pick up some acres, and even with the trend line type of yield or a yield of the last few years, and it still means average farm price that's above 4 instead of below it. Now, specific corn versus bean decisions, I think, come down to the on-farm yield ratio that a guy's looking at, not necessarily the price, certainly not what you think prices will do, but your on-farm yield expectation is going to be top factor in that. Some ethanol stocks. Back to you, Tim.
Yeah, I like this chart. When we first started showing ethanol data, we used to have a dozen or more charts and graphs. I was actually a participant with Dr. Wisner of Iowa State 20-some years ago. We were part of a focus group. Dr. Wisner did a fantastic job to
Oh, Tim, I think you muted yourself.
Sorry about that. We've whittled everything down to this one chart, and I say so with somewhat caution that past history of stocks and production pretty much means nothing. But for a guy like me who has a lot of business consultants on fresh commodities or perishable commodities, there's such a thing as balance, that commodity has to stay in balance. So what this chart tells me that production can't go up if stocks goes up at the same time. And that's kind of where we're at in ethanol. We did have a good week last week. We are getting this data, so this is updated. We'll get new data tomorrow. But nevertheless, stocks for ethanol are high, and we can only produce so much ethanol. So we're probably going to operate at slightly less than capacity for just a little while longer. And USDA hopefully will update us when they get back in business. Go ahead, Jason.
All right. Some Q1 corn disappearance in stocks. Again, we needed that report to really verify that. There's not many people that are willing to do market outlook or put statistics out at this point in time in the absence of USDA data. So we just put it out on roughly where some latest projections were, and just that it trended out a little bit from the last couple of years. The main takeaway in Illinois did build some, so that's going a little bit the different trend than nationally, where we're climbing in Illinois. Although 17 to 18, we don't have 18 yet. A lot of piles on the ground in 17. There seems to be, as reported by the commercials, less ground piles of corn in 18 than in 17. But so this is through 17. This doesn't even have the 18 one on there. Feed and residual, of the demand categories, your major ones, exports, feed, and ethanol. Feed is the category that they throw residual in there, which is where they put their cumulative errors in there. Like we've added up these bushels and we've measured this here and we've surveyed the rest here, and man, our math is not working. Well, we use the residual, which happens to also be feed demand, as our error account to reconcile it. And the volatility on what this category, because it includes residual due, the longer we wait to get some USDA data could frankly grow. But feed and residual on the higher end of history. Ethanol coming down in the first quarter, and that's really, heck, that's before a lot of the total collapse in energy prices over the last month. Corn basis, in central Illinois was quite a bit under the previous year, just like beans were. Really, this was in conjunction with beans. Even though corn carryout was declining, despite bean carryout increasing. And yeah, Tim, you got a lot of feedback there, buddy. On the barge basis at the Gulf, had been running a bit greater than normal. That there was still some buying interest with stocks a little bit declining, even in the beginning of the marketing year, and even with what was going on with China. But that's where basis is. Central Illinois cash price, we actually made a bottom there in September. The high is presently in January. The futures high was actually in December, not January. So basis has improved enough in the last month and a half, even though it's kind of started going back the other way. But it's improved enough in the last month and a half that even though futures peaked in December, cash prices continues to move higher and actually peaked itself here in January. Seasonality on corn, over those same 48 years, just like beans, it's either happening early, like in September of the marketing year, or happening late. This long run side of the odds says, selling in June, July, or May, June, July would be where your greater long run odds are. But just like beans, last year really defied the odds in corn seasonality too. And the red star is presently where our current high of the marketing year is. As I said on the previous slide, January. And just like on beans, we've got about 30% of the years behind us and 70% ahead of us. But even though 70% chance, possibly that the high is still ahead of us, because of what happened last year and the high coming in May, 70% ahead of us or not means can't necessarily bank on or wait for typical June, July, middle of the growing season type of seasonality to sell at the same proportions as you have historically. And making lows in the corn, current lows in September, and frankly, and now that we're at January, there's 60 to 2/3 odds that the lows in, and where we made the low last year, a little different on the lows than the highs as far as sticking to typical historical tendencies. So, Tim, to you to summarize this up, and then we'll get into questions.
Sure. Just from an economic standpoint, I started my career actually in the equity side, so I follow a lot of economic trends. We have been in a long expansion phase, and most everything's still intact, but we are slowing down. And it sure does seem like the new tax overhaul will help, but we haven't really been able to quantify what sectors of the economy it's helping. We know the trade tariffs have hurt producers from the get-go. I will work with a lot of dairy producers. They're basically on both knees, waiting for anything good to happen. The Mexico-Canada thing really hasn't helped them because there's still a tariff on cheese. We are selling powder, milk powder to Mexico, but not cheese. And Jason and I watch crop production across a broad area of the country. Illinois is very strategically located to supply the poultry industry, corn and soybeans. This year, though, Illinois raised more soybeans than almost all the southern states combined. So that's part of the reason why soybean basis hasn't recovered as much as it possibly could. The crush industry has to use up those soybeans before we can get to Illinois soybeans. And the carryover based on where ethanol's use of corn is maybe a little higher. So over the course of the next several crop reports, when they do resume, corn carryover actually could be a little higher than we illustrated earlier in our corn balance sheet. And certainly this farm structure thing, this issue's been, we get a lot of lenders that come to our meetings all the time. They're concerned to try and do all they can to support small families and farms, but nevertheless, the challenge these last 4 years of declining farm income has been wicked tough. So it's going to happen. You can't hardly change that. So we do expect to see farm sizes and the number of farms change over time. Okay, Rachel.
Well, one of the last things I'll say is that we'd like this to not be we'd like this to be the first of many installations where we'll come to you with a webinar and talk market outlook amongst other topics. But we could use some feedback on what you might like to hear next time. If it's a deeper analysis of specific marketing price protection strategies, or looking at how to solve some transportation logistical issues that you might be facing, or market-related, basis-related, cash contract or other tools that you have, and using them related. We can come up with a topic ourselves, but any guidance or feedback on what you might like to hear next time would be most helpful.
Sounds good. Well, at this point, let's open up for some questions. I know I had one submitted, so I'll go ahead and start with that. What about fertilizer outlook? What are some of your thoughts on that? Can you go a little bit deeper there?
Yeah, sure. Frankly, there's probably more upside risk than downside potential in fertilizer from this point forward. Or there has been over the last month. What happened, and it hurt a lot of farmers, had such a large quantity of unsold crop coming out of harvest that for cash flow reasons did not look at purchasing fertilizer at seasonally good time to do so, because didn't have the cash flow from having enough crop sold to be in a good position to do that. So kind of deferred, because they were deferring sales. They also deferred the fertilizer purchase, and that's hurt. So probably more upside risk still. Would make sense to start biting off that purchasing decision if you haven't. Seasonally, the last week of December, call it the last half of December, the first half of January is typically your most opportune time to buy it. So if you haven't yet, we'd certainly consider it.
All right. Any additional questions on the line? Well, if not, let's remind our viewers how they can get a hold of Tim or Jason. Do you want to go ahead and give us your contact information so that we can have people reach out with further questions?
Yeah, I'd be happy to, and I think you can see it on the screen here. Our addresses and our phone numbers, our emails. Welcome to get a hold of us anyway, anytime, and I would say expect us to be back with you on a similar or special topic within the month.
All right, very good. Well, thank you so much.
Thank you.
Thanks, everyone. Thank you, Rachel.